The Nasdaq market closed for the week on Friday, October 24, 2025, with Rezolve AI PLC under the ticker RZLV, closing the day at $4.72, representing a positive movement of plus 6.31% or 0.28 cents from its previous close. Now, here's the immediate insight that cuts through the noise of that solid green finish. What drove the last leg of that rally wasn't some unexpected last-minute sales contract, but a quiet, sustained institutional accumulation that has been subtly shifting the supply-demand balance over the last 2 weeks, a signal that long-term capital is beginning to validate a story the short sellers have been vehemently disputing. The stock's expectation, fueled by a heavily publicized short report, has been one of imminent failure and a return to penny stock status. The reality, however, is a company aggressively raising capital, executing a distinct M&A strategy and managing to attract significant, fundamental long-hold investors, even as it faces intense scrutiny, suggesting a deeply polarized view among sophisticated players. And that polarization is exactly what makes RZLV's recent price action so volatile and fascinating. The general belief about Rezolve AI is straightforward. It is a high-risk, high-reward AI commerce startup that recently went public through a somewhat unconventional route, now trying to carve out a serious niche in a crowded field. The prevailing bearish narrative, which holds a lot of weight in the current retail investor mindset, especially on platforms like Reddit and X, is that the company is overvalued, has a low revenue base, and that its technology and acquired assets are not nearly as compelling or integrated as management suggests. This perspective is a potent force, as skepticism around AI hype is high. However, the contrarian take, the deeper reality, is that this company isn't just selling general AI, it's building a proprietary agentic commerce framework that fuses AI-driven engagement, visual search, and crucially, a next-generation payments backbone through recent strategic acquisitions like Subsquid and SmartPay. That $200 million oversubscribed financing round closed in late September, anchored by fundamental institutional investors, is a clear, tangible validation that smart money is looking past the current revenue figures and focusing on the strategic asset accumulation and the potential of the core platform to capture a meaningful piece of the massive global retail market. The money is there, the institutional commitment is growing. You don't see Citadel, BlackRock, and Vanguard taking positions in a company they think is a total mirage, regardless of how small those initial positions might be relative to their total assets. It signals a belief in the structural narrative, and that's a key distinction from the purely promotional hype story the shorts are pushing. Focusing on the recent movement, the stock's daily swings have been aggressive, reflecting the tug-of-war between sellers, who are largely short-driven, and buyers who seem to be anticipating a positive catalyst or simply accumulating on weakness. The trading volume for Friday was over 10 million shares, slightly below the 90-day average, but still substantial enough to move the price with conviction. The stock spent most of the day grinding upward from its open of $4.58, hitting an intraday high of $4.85 before settling slightly back, a pattern that suggests sustained buying interest rather than a single pump-and-dump spike. This recent momentum comes on the heels of a significant drop following the short report from Fuzzy Panda Research published in late September, which alleged deceptive practices regarding AI capabilities and revenue growth. The stock saw a dramatic dip, creating a classic reaction where the short seller's thesis initially wins on fear. But in the weeks since, we've seen a gradual recovery, punctuated by the company's strategic announcements, like the October 22nd restructuring to strengthen the leadership team for global scale and AI innovation. Every time the shorts try to press their advantage, fundamental buyers appear to be stepping in, creating a solid base of support in the mid-$4 range. This pattern of a sustained fight at a key price level after a major attack is exactly what one watches for when judging if the market truly believes the short report or if it's viewing it as a coordinated attack to drive down the price for profit-taking. The recent institutional share transfer to a new global long-hold investor disclosed on October 10th, even as an estate-related administrative matter, adds another layer of long-term validation right in the middle of this market cook pressure. Now, let's look straight at the short-selling dynamics, which are absolutely central to RZLV's trading profile. This stock is undeniably under significant short-selling pressure. The most recent publicly available short interest data is alarming. We're looking at 11.55 million shares held short as of the last report, which is a massive number considering the total share count. More importantly, the days to cover figure is high, indicating it would take several days of average trading volume for the shorts to cover their positions, which is the exact setup for a potential short squeeze. The short borrow fee rates, while fluctuating, have been elevated, hovering in the 12 to 15% range over the past few weeks, a clear sign that demand to borrow shares is high and the risk for short sellers is increasing. We've also seen notable fails to deliver data in late September, with millions of shares failing, which is a strong signal of either naked short-selling activity or simply systemic settlement issues due to high volume and a complex float structure, a classic debate raging across market forums right now. Fuzzy Panda Research, and likely others, are the institutional-grade players with the capital to build these large short positions, and their motive is simple. They see a high price-to-sales ratio, which is indeed currently astronomical, and a lack of immediate profitability, betting that the retail-fueled hype will collapse before the business model takes hold. Their thesis is that the acquisitions are merely to inflate annual recurring revenue figures, a practice they claim is deceptive. The actionable insight here for the retail investor is that you need to be monitoring the days-to-cover ratio weekly and watching for a sustained drop in the borrow rate. A sudden spike in daily volume coupled with a low share count available to borrow, which recently stood at around 2.1 million, could trigger a sharp upward move. However, you must be disciplined. Short squeezes are parabolic and often short-lived. A responsible approach is to find the most factual short interest and FTD data, available through sites like FINRA or NASDAQ, and use it as a measure of market tension, not as a guaranteed path to riches. What's your take on the rising short interest? Smart money or manipulation? Comment below with your thoughts. At its core, Rezolve AI provides a proprietary AI-powered commerce solution, often referred to as its brain suite, designed to improve customer engagement and operational efficiency for retailers and brands. Think of it as an enterprise-grade platform that integrates visual search, natural language processing for customer service, and a checkout system into a single, cohesive experience. The business model is primarily SaaS, software as a service, charging enterprise clients based on licenses, usage, and value-added features. The recent acquisitions are aimed at vertically integrating the commerce infrastructure. SmartPay brought digital asset payment rails, and Subsquid provided decentralized data infrastructure, essentially building the pipes for what the company calls agentic commerce, a model where autonomous AI agents handle complex transactions and customer interactions. This is the narrative value that institutions are clearly buying into, a foundational layer for the next generation of retail. Past performance shows this is still a company in an aggressive growth phase with high operational costs. Their latest guidance projects a goal of exceeding $100 million in ARR this year, a figure that is being heavily scrutinized by the shorts but strongly reaffirmed by management. Older reports highlight significant revenue growth, a reported 426% year-over-year in a recent quarter, but also significant net losses, which is typical for a high-growth tech company prioritizing market share over immediate profitability. This is the expectation versus reality tension again. The market expects profitability, the company is delivering massive growth and strategic integration. Looking ahead, the future outlook for RZLV hinges entirely on execution. The key catalyst is the integration of the acquired technologies and the successful deployment of their agentic commerce platform with major enterprise clients. A positive earnings report that can provide undeniable point proofs on their claimed ARR figures would immediately invalidate a major part of the short thesis. Further institutional filings showing increased positions from the long-hold funds would also provide powerful momentum. The opportunities lie in their partnerships. Their association with tech giants like Microsoft and Google suggests a legitimate distribution and technology validation channel that few small-cap companies possess. If they can successfully leverage these partnerships to gain footing with large global retailers, the long-term growth story has real legs. The risks are obvious and tied directly to the short thesis. If the claimed ARR figures prove to be unsustainable, or if the integration of the acquired companies fails to yield a cohesive marketable product, the stock price will certainly face severe pressure. Furthermore, a failure to raise additional capital efficiently, despite the recent success, to cover the current high operational burn rate would be catastrophic. The threat of follow-on offerings, which inherently dilute existing shareholders, will hang over the stock until the company achieves positive cash flow. Investors should monitor option open interest for unusual activity, specifically large blocks of call options bought far out of the money, which could signal institutional anticipation of a sharp price rise. Additionally, watch the volume and price action next week following any new class action investigation announcements, as these often create fear-based selling opportunities for shorts to cover at lower prices. The central insight remains that the volatility in RZLV is a function of the intense conflict between a strategic, institutional long thesis centered on the future of agentic commerce and an aggressive, research-driven short thesis focused on near-term financials and perceived valuation anomalies. The expectations are that a company with losses shouldn't be worth this much. The reality is that the new crop of fundamental investors is betting on the future commercialization of an integrated AI payments platform for a $30 trillion industry, and they're willing to endure the volatility to build their positions. The ultimate direction of RZLV is not a simple question of good product or bad product, but a dramatic showdown between long-term vision and short-term financial skepticism, a story that is far from over.